Transition management. What is it? And what risks might you encounter if you must do it? The vast majority of institutional buy-side investors, such as pension funds and endowments, hire external third-party money managers to manage their assets. These money managers might be either equity managers, fixed income managers, or alternative investment managers. At any point in time, these institutional investors may decide it is time to change investment managers. The process of switching to a new manager is known as transition management, and firms that offer expertise in this area are known as transition managers. There are several reasons you might transition from one manager to another. An investor may change the asset allocation policy, which requires finding a new manager who has expertise in the product you want to invest. Or the previous manager may be underperforming and you want to find an alternative manager. Sometimes these are organizational changes that may cause a shift in the investment strategy, such as shifting the focus from passive to active investing. And most recently, the industry has encountered more complex transitions that involve derivatives such as swaps, options, and futures. For these products, investors may need a transition manager with a different set of skills and experience. What are the considerations and risks when transitioning a portfolio from one manager to another? Anytime you sell a portfolio and reinvest in another, you incur costs. Transaction costs, commissions, and other fees can be performance killers. However, the biggest risk during the transition period is having no exposure to the market during the process. One of the ways to combat this risk of missing out is to utilize the futures markets. Say, for example, an endowment was going to move their small cap exposure from an active small cap manager to a passive indexer benchmarked to the Russell 2000 index. From the time securities are sold from the legacy manager to the time new ones are purchased by the passive small cap manager, there is the risk that the Russell 2000 might rise, resulting in tracking error and underperformance. Therefore, a transition manager could use E-mini Russell 2000 futures to mitigate this risk. Whether an investor benchmarks to large cap indexes, mid cap indexes, small caps, sectors, or international indexes, there are literally dozens of liquid stock index futures available that replicate many key global benchmarks. It's no surprise that transition managers have come to rely on these instruments to transition portfolios smoothly and quickly.